Bob and I are going to, after you guys got your tax, your international tax and your A&A update on, we're going to move on and talk about some corporate divorce, resolving disputes between shareholders or equity owners of a business. So we're going to talk a little bit about the causes of these actions, moving into some remedies. Also talk about valuation issues, which we know are at the heart of this type of situation or dispute. Also, forensic issues come into play, and we'll talk about those services and those aspects of a project. And then I'm going to wrap things up talking about some recent court cases that have gone down here in Pennsylvania, and one, in fact, was in Allegheny County. So without any further ado, I'm going to turn things over to Bob to start talking about causes of corporate divorce.
Yeah, before we do that, just a couple of important items. This is my partner, Melissa Bizyak, for those of you that do not know Melissa. Melissa works out of the Business Valuation Services group primarily of the firm, and I work out of the tax group and support the Business Valuation group as well. So that's our background, so you know where she's from. So she doesn't know what she's talking about most of the time. The other thing that's important is I was sitting back here glazed over a little bit at the end, right before break, on this revenue recognition thing. And I was, I almost zoned completely out, but then I see this 25-25. I guess I'd ask Charlie Darrimer or Jim Troy, who sang that song, 25-25? Zager and Evans, that's right, 1968. You should know that.
Bob, some of us weren't around in 1968.
That'll be on the quiz later. You young punks would never get that. So we're going to talk, as Melissa said, about corporate divorce. And when we talk about corporate divorce, we're talking primarily shareholder disputes or equity owner disputes that arise among common owners of a company. We generally handle between 10 and 15 live cases or ongoing legal matters or situational issues that could lead to litigation at any one time. Out of those number, probably 75 to 80% of them deal with these shareholder disputes and people that are not happy with the person on the other side of what's going on. So that's really what we're going to talk about. And we'll talk about where we think some of these issues arise from, what maybe are the resolution opportunities that are out there to take a look at that, and maybe how best to resolve those issues. And then finally, as Melissa said, we're going to talk about some of the valuation nuances and some of the forensic issues that are there if we have time. So the key is where's the discord arise and how's the discord addressed? Well, the discord, as the slide says, among equity owner groups, it comes from all over. It comes from any number of directions, and we'll talk about some of those in a minute. The thing that's important to understand that as in any relationship, whether it's a divorce from your partners in business or a divorce from your spouse or friends that you've seen get divorced, it doesn't really matter if the issue is real. If it's perceived, it's going to cause trauma. And so if there's a perception of some kind of shareholder abuse or shareholder discord, then that's almost the same thing as if there is. So a lot of the cases that we work on is trying to ameliorate people who are maybe oversensitive to certain dynamics that are going on in their company, and we try to put them back on the path to getting along with each other and trying to understand that. There's no question that private ownership groups have a lot of dynamics between the people. And the issue is a failure at the front of the transaction, at the front of the setup of the business, to face the realities of the what might be's or the what ifs. And so, on day one, when we're all hugging and happy and shaking hands and taking the pictures, day one of the business, everybody's excited. Nobody's thinking on day one that on day one of year 11, you're going to hate each other's guts. And so you need to basically prepare for that early on, and the place to do that is governing documents and open communication. So the issue is, once the discord arises, we're going to be looking back at those documents, but the answer for you or for the clients that you look at or the people you're helping, they need to basically be communicating. Failure to look at it, denial, is not going to be an answer to this, and it's not going to help in any way. Now, in most cases, understanding capital structure becomes a important aspect of this, because in most instances, the difference between a controlling equity owner and a non-controlling equity owner is the basis on which the abuse is alleged. And of course, the outcome of that is simply that we're looking at the the perception, at least, if not reality, that the minority shareholder or the non-controlling equity owner is being abused in some way by the controlling equity owner. And that's most of the cases that we take a look at. But the sources of that abuse or that dismay, that's where you have to look at different ways and where it can come from as well.
One of the things I'll talk about at the end, it's that if these issues make it to court, which is not the best situation, Bob and I talk to our clients, if we have a very contentious situation, we talk to them about, hey, let's try to get this resolved. When it gets to court, courts don't want to deal with these things, and when it gets to court, they have a lot of latitude in what they're going to decide. So don't put your business and the value of your business, or even the ultimate future of your business, in the hands of the court. Because I'll talk about at the end a couple of court decisions. But one of the things that is always the common theme is, for a minority shareholder, maybe someone who's not active in the business, that perception is huge. And what the courts are looking to, and what attorneys look to, is reasonable expectations on the part of the shareholder. So there have to be reasonable expectations on the majority shareholders to act as a fiduciary.
So what are some of these actions that people look at from a minority or non-controlling shareholder situation that they convey or they sense has something to do with an abuse situation? Well, again, as we said, it's very broad, but the primary one, the primary ones that we'll talk about is, first is this business use of assets by the equity owner. And here, you've either proven that the control shareholder or you're at least alleging that he or she has basically misappropriated corporate assets and corporate funds in some way for their own enrichment. That's really not uncommon. And there's very simple examples of that. We've seen wholesale stealing that has risen to the level of theft and fraud type cases with controlling shareholders. Most often, there's this idea that there's an entitlement to the people that are running the company. So things like overstating expenses, maybe allocating corporate assets for their own personal use, using company vehicles for non-business related matters. Those are the kind of things we also see all the time. It doesn't have to be a big dollar issue. It has to be an issue that you answer from the minority shareholder's position as one of fairness. So where that person starts to believe that this is not a fair situation, then you're going to start to get this discord that we're talking about as well. So, you can take corporate monies, as we said. That's obviously something that we see very often. It's in almost every case that we work on as well. It starts due to insufficient internal controls, and then you basically, as I said, misdirect the assets and so forth. The final point on the slide is important. The fact of the matter is, once you know that your partner is misdirecting assets to herself or to himself, there's a level of trust that gets penetrated at that point and severed. And that point of trust is like in any personal relationship, is an issue that's hard to overcome. So once we start to see that, we go into issues that we very often run into emotions that are running so high that you have to almost have cooling down periods to give people a chance to regroup and refocus on what they're getting to.
But as you know, and what we talk to our clients about, when you have that situation where, the perception is there and there's the lack of trust, basically in our relationships, crumbling up a piece of paper, and after that, the recovery is trying to straighten out that paper and make some sense of it. So that's when, we become involved in helping them navigate through the endless financial issues and trying to uncover if, in fact, any of those improprieties have transpired.
Yeah, another area that we see people running into problems that we get involved in these kind of cases is, where people are running into civil or criminal type activities. And when you talk about that, they're not actually out generally robbing banks, but you run into income tax improprieties, and we run into a lot of situations that we've seen over time where people improperly report operating results and financial information to the other shareholders. And without that kind of information, of course, the minority shareholders are at the bent of whatever activities the controlling shareholders want to take on. So that's an issue that's significant. And then sometimes it reaches even above that perhaps non-performance is an issue with the controlling shareholders who are managing the business, the controlling equity owners. You get into a circumstance or situation there where they're misrepresenting information to the bank, basically to protect their own self-interest, their own bonus calculations, or to hide certain activities within the company from the bank, and we get into those kind of situations. We did some work years ago with the LeNature's transaction down in Latrobe. It really wasn't a shareholder dispute per se, but it was a real misrepresentation issue to all the lenders by the party that ended up ultimately going to jail. Then there are personal conduct issues that are problematic too. So if I'm in business with my partner, Bill is, has some sexual misconduct in the office, or perhaps DUIs, perhaps drug activities, things that really taint the opportunity of the company to not only maintain its value, but build value going forward. In those instances, we run into a lot of situations where we get into shareholder fights because people are trying to remove that person and distance them from the activities being conducted by the ongoing business enterprise. Those are the kind of things that we look at as well. Another place we see abuse is using corporate monies to advance personal interests. We see a lot of people, one example is basically looking at donating money to perhaps an elite school or some organization by which the owner, donating corporate funds or business funds, is looking at that as a means for enhancing their own ability to further their own self-interest in that, maybe getting their kid into one of the more elite secondary schools, et cetera. Those kind of things are what we're talking about. The other is hiring individuals with personal relationships to the owners. Everybody's familiar with that. Almost always in a valuation context, when Melissa and I go in and we see a business with related party employees, we have to evaluate, step back and evaluate whether those people are rendering any type of valuable service at all in exchange for the funds they're taking back. And we've seen a number of disputes, the issue out near the airport, where intercompany employees or interfamily employees with external shareholders are looking at that as abuse situation. The other is financial success and distress, and it can go either way. I mean, if it's a distressed situation, then you have to look at how the profits are going to be spent, whether or not you're going to reinvest in the business to help it grow and move forward, or alternatively, you're going to make distributions to the owner. So the issues there are very often tied to what's possible and what's reasonable, and not always are you going to be able to accommodate all shareholders and equity owners' idea of fairness in those situations. So a lot of times we run into that circumstance where we see people that are really not happy that they haven't gotten the distributions they think they're entitled to, but at the same time, the company really doesn't have the funding to do that, plus make certain corporate moves. So that's an issue as well. And it's the same thing in the reverse, because if it's doing well and you're arguing over distributions, you can imagine then easily that if it's not doing well economically and the business is struggling somewhat, then those decisions become even more paramount to assuming a position of fairness among the parties.
We see this all the time with the passive investors in a company, the minority investors, that they're kind of the armchair quarterbacks. So, they're sitting on the sidelines of the game, making predictions and making assumptions of things that should be done. But what this falls back to in all jurisdictions, in all cases, is the good business rule, the good judgment, or the business judgment rule, I'm sorry. So if management, majority shareholders, officers of the company, board of directors are acting as fiduciaries and making decisions on behalf of the company rather than on behalf of themselves, that will carry the day.
Yeah, the other thing to keep in mind, and again, remember again that this breaches reality and sometimes moves into perception, zones of perception. So bad feelings, are often at the root of a lot of this. And perhaps, every malfeasance that's alleged by the abused or the potentially abused party really aren't well-founded. Other things that we see that cause, corporate divorce, that cause a lot of issues are these issues that you see on the screen that are more personal in nature. But somebody's getting divorced, those marital dissolution proceedings can be a nightmare for the other business owners. And then the reality of ultimately of the equity interest owned by the property spouse in conjunction with the divorce, who's going to get that ownership interest and who's going to be able to do that. And we see people trying to sell shares back, for example, or equity ownership interest back in exchange for funds to be able to pay off the marital distribution ruling by the courts where they need cash to do that. We see any number of divorce-related items that can ultimately interfere, not to mention the fact that I'm trying to do my job, but at the same time my personal life's completely falling apart. So that's an issue as well that we often see at the root of some of these issues. And then any one of these other items could certainly be there. College funding issues could lead to corporate abuse, basically trying to leak more monies out through through any of the other items that we talked about, the other methodologies. Some significant illness in the majority shareholders or the abusing shareholder's family or his spouse. Retirement issues that are out there as well. And then these other ones, alternate investments and S-corp elections are causes for that. Not all of these as well, when we talk about corporate divorce, are nasty divorces. We all know somebody that got divorced and they get along great. I don't know, my wife says that's not possible, so I'm staying married. But the reality is, we run into a lot of circumstances where we see corporations with a lot of shareholders. And the smart play right now from a tax perspective is to be a pass-through entity or an S-corp. So if we have more than the qualifying number under 1361, maybe 110 shareholders or 130 shareholders, and we've seen this numerous times throughout our careers, then we'll look to identify those small minority shareholders and we'll try to buy them out. I mean, we're basically separating them from the ownership of the company, but at the same time, it's not really, in most circumstances, an absolutely nasty, knockdown, drag-out fight, and that's pretty common as well. We look at equity owner freeze-outs. Those are both positive and negative. I mean, sometimes those are controversial and run into an issue, but the idea there is basically to squeeze out the minority shareholders out of the company, so long as they get fair value, and Melissa's going to talk about fair value with respect to their ownership interest, no harm, no foul. But to the extent that there's an argument made that the departing shareholders that were frozen out didn't get fair value, now we have a controversy that breeds our involvement, gets into that kind of thing as well. So those are just kind of a broad sensibility of the kind of things that we often see in conjunction with trying to get shareholders to settle these kind of arguments among themselves or equity owners. The issue becomes one of kind of almost like a case study. You get the call from legal counsel or you get the call from the clients or one of the shareholders saying, Joe's done this, this, and this, or I have a minority shareholder who's causing me this grief. So the issue really is how best to resolve that. And just as is the case, it would be my advice in any divorce transaction between spouses, the way to dissolve it is fast. The faster you resolve it, the less attorney involvement you have, the less controversies in there, and the less time you have to build up animosity between the parties. So that's always the issue. It starts with open communication to solve it fast, and it's an informal process. You want to go into a position where you're trying to talk to your partner as that person that you were shaking hands and hugging that I mentioned on day one. I mean, maybe you can't continue on in business together. That's a personality disorder maybe, or a personality conflict. Maybe it's a technical issue. Maybe it's a problem with perceived abuses. But in any case, treating that person fair and getting back to where you were at the beginning of the business is the best place to start. And that starts without you going in as the abused or the alleged abused owner and to talk to your partner and bringing in your accountant and 3 lawyers. I mean, it's not going to go over, obviously, as smoothly as if it's the 2 of you. And so you get the sense, and that's what we try to advise people, start first at that level. And there are different ways to do that that we're going to go through together, Melissa and I, to kind of explain that.
Yeah, a starting point would be attempting to do this without advisors, not putting on the pressure and not adding that level of formality. So, the starting point is to get all parties together to meet and to talk. Because as we spoke at the beginning, a lot of these things can be perception on the part of the passive investor or the minority shareholder. So, this informal meeting can be done to clear up some of these misconceptions and perceptions that they have and to work through some of these issues. And, depending on those historical relationships, those strong ties that were developed at the very beginning or the onset of the business, and using that as a foundation for a reasonable conversation and sense of common interest. So the goal there in that juncture is to create a framework for a formal resolution. But these can also lead to negative results. The possibility of revealing information that could either be detrimental to the owners of the company, the owner's position, the majority shareholder. So we don't want to get in a situation where we're divulging too much, because that might lead to a very detrimental situation. sometimes during these meetings without advisors, you don't have that sanity check. You don't have that sounding board there, someone to kind of rein you in. So it might be a situation where we're agreeing to something that may not be possible, something that may not be able to be attainable by the company. Putting an unrealistic value on the minority interest shares and the company not being able to buy that back with the current financial condition. So what we recommend is owners should speak to their trusted advisors in advance of this meeting to kind of set up the expectations and set up a framework for them to conduct the meeting. Oh, I'm sorry. Success in the process in this process requires obviously objective and thoughtful discussion from all parties. And as we know, in having meetings like this, that doesn't always happen. What we see in a very contentious situation is emotions overrunning and then leading to a situation where we might move into having a meeting with advisors.
Yeah, that point that she makes, you have to overcome the emotions. We have been in meetings, literally, I mean, this is absolutely true, where Melissa, I felt she was at risk physically because one of the contentious parties, this was a family that was fighting, they were equity owners, and they're shoving the door shut when the attorney's trying to get in the room, and he's squeezing the attorney between the door and the frame of the door, and it was kind of out of control.
Oh, we were just sitting there, not knowing what to do.
So, I mean, you can't, obviously that's an extreme example, but the idea is more importantly is to understand that emotions are not going to carry the day in any of these activities. I mean, it can be a very simple, I don't want to say simple, but it can be a very normal order type divorce, even in a couple, and it can go okay, but it's hard to pull out the emotions. And money at the end of the day, monetary issues, which is what most of this is about, is something that emotions don't have a role in. And we see it all the time, but it's unfortunate. Now, the next level of formality without having any advisors there present at the meetings where you try to talk through the issues, try to get a better understanding of that, is where you bring in your advisors. And the first advisor is generally the corporate attorney, because the corporate attorney generally works on behalf of all shareholders. The problem with that is, again, in situations where we've been appointed as the expert by the court or by the parties to be the expert from both sides, I would have to tell you our experience has been that almost every time at the end, one side is not happy, and so the whole thing falls apart anyway. And it works the same with having the corporate attorney involved. There are times or occasions where he or she can be there, but there are also other times where they definitely don't have the independence to be able to be as objective as necessary to counsel the abused party, in particular, or the alleged abused party. So that's important to keep that in mind, because that's something that we see as an ongoing issue as well. The benefits from this kind of a more formal atmosphere is a lot of the emotions are pulled out, although the attorney was the one being pressed into the doorframe. But it's a little more businesslike, and the real upside is that you do have someone there, generally legal counsel, who can at least talk to some of the more complex issues in the event that either of the parties can't address that. So you have that ability as well. So the flip on it is that formality always leads to more defensiveness and a reticence on the part of anybody attending one of those meetings to just speak without careful thought, especially, absolutely if you have some sense. So people don't generally ramble once legal counsels are there as well.
I think we should move through these pretty quickly.
Okay.
Go ahead.
So mediation is a third route. So we had without advisors, with advisors. Mediation is another sense that we have as well. This basically is not a binding situation in most cases unless the parties agree, but it's basically an issue of being able to bring in an independent party, the mediator, and let him or her mediate the circumstances that are driving the controversy in the first place. And it's an approach that we see quite a bit that we use.
Next is bringing in the use of a trusted advisor. It can be an attorney, accountant. I wouldn't recommend close friend, but somebody that is trustworthy, also qualified to be able to speak with respect to these matters, and the ability to maintain that independence and objectivity, and obviously free from conflict. You don't want to be seen as an advocate.
Ms.
I can talk to it. Engagement of outside management, this is something that we rarely see, but it can happen, where actually an outside management team is brought into a corporate divorce situation. What we find is, and we have this situation with one of our clients, basically with two 50% shareholders, one is active, one is not. What we did is we brought in a third party, an independent party, who is there to act as part of the board of directors and as a sounding board and to break any deadlock that they have.
Yeah, it's not unusual. I mean, I shouldn't say it's not unusual. It is unusual. But we have observed on more than one occasion where the courts have appointed someone to come in and actually run the company in lieu of the current ownership group. Not that they didn't have a role, but it was primarily moved to an independent outside management group. Business reorgs. Business reorgs are a way to separate the business if your circumstances and the facts allow you to do that. Primarily, we're talking about split-offs and split-ups that would essentially see two business lines similar in value, and basically you and I each own 50% of the company. You can do a 355 spin-off, a transaction, and you can drop one of those businesses out, and the end result is you own 100% of the one business, I own 100% of the other business, and we go our own ways. Not something that fits every situation because of the unique facts that are required to do that. And then finally, though it might seem extreme, we have seen people that are forced to sell the business or part of the business. Now, a sell the whole business is not something that we've seen on a regular basis. We have observed it on occasion, but that's a very drastic action. Most of the time, it's a single equity owner buyout, and so that's where we're getting into the valuation issues and the issues that we have to deal with in making the abused party or the alleged abused party feel as if he or she is being treated fairly. So that's really what we're talking about there as well. And then finally, arbitration, which is generally a binding process that we see. If the agreements and the documents provide for that type of result, a binding result, then it's non-voluntary because it's guided by the organization documents of the entity. And then lastly, resolution in court. Time doesn't allow us to get into all the alternative issues that can happen in a court proceeding, but that's the last place you want to end up, primarily because it's going to erode the value that's inherent in the shareholders' equity interest that they own. So you're going to spend a lot of money there. We're going to turn it over to Melissa, let her talk a little bit about valuation issues. I would say that when you're talking about resolutions for disputes, again, the formality is something you want to get into later and try to resolve it peacefully, if you will, up front. And maybe as accountants, maybe as people that are closer to the management group, as CFOs and CEOs, you have the capability of helping them bridge some of those gaps to get those parties that feel as if they've been harmed satisfied and moving on.
So at the heart of these disputes, any of these transactions with shareholders, whether it's a situation where things are copacetic or if it's going to lead to litigation, the most popular route is to buy out the minority shareholder. So valuation issues are critical, and they're going to be at the heart of every engagement like this. So aspects of valuation for shareholder disputes or shareholder split-ups are unique. So what we would recommend when you're hiring, when you're looking to engage a valuator, you're actually going to engage a qualified valuator. You're not going to go to the accountants and ask them to calculate a value, because we might have a situation where if things get a little bit more contentious, you're going to bring in someone like us to come in and prepare a quality valuation or actually formalize that valuation. So, the last point on there is the lack of a quality valuation can prove as a costly mistake or misstep when you're engaging in this type of issue or resolution. I talked to you about how critical it is to... I can't move, Bob.
Yeah, me neither.
I can't move, big guy.
There we go. Got it.
There we go.
Okay.
I spoke to how critical it is to engage someone. And if we do know it's a situation where it's going to court, you want to make sure that you engage someone who has the experience, who has been involved in these types of issues, and particularly has knowledge in your jurisdiction, because that can vary from jurisdiction to jurisdiction. Bob and I do work in Pennsylvania and Allegheny County, where we're a fair value state, and I'll talk about that in a moment, but we have actually worked in other states where it might not be fair value, where it's more akin to fair market value. So you need to have someone that is qualified and understands understands what is acceptable in that jurisdiction. And ultimately, we are going to be refraining, we're going to be independent, we're going to refrain from advocacy. We're there to assist the trier of fact. If we come in on an independent basis and just helping the shareholders or management or board of directors of the company, we're coming in on an independent and objective basis. So we're going to refrain from any type of advocacy. Purpose of the valuation is very important. So it can range from just helping management establish a reasonable purchase price for the exiting owner's shares. It can be in accordance, typically in accordance with a buy-sell agreement. That buy-sell agreement might be dated, so we may need to walk through some issues to ensure that we don't end up having significant controversy down the line. We can be involved in negotiating with a selling equity holder, or we can be involved at the high level, and we're there to help resolve the dispute in value in front of the court. So if there's a buy-sell agreement, obviously we're going to look to that first. We're going to have an understanding of how the buy-sell agreement speaks to value upon a triggering event. So we see most often three things: an agreed upon value, we see a formula or a formulaic approach, and then we see the engaging or the hiring of a third-party appraiser. And sometimes that can get a little crazy because sometimes the company will hire an appraiser, the exiting shareholder will hire an appraiser, and if they don't agree, then a third appraiser comes in, so it can get pretty convoluted. But what we're seeing in the first two buckets is a situation where that agreed-upon value may no longer be valid. It might be something that they placed in the buy-sell agreement at the outset, and that value is no longer something that is remotely close to being fair and equitable to the exiting shareholder. So same with a formula approach.
Yeah. That being said, though, I would tell you that where we see a lot of issues are in the organization documents that are drafted by these companies at inception. And because they haven't properly broached these types of topics, and Melissa will get into the independent valuator approach, but because they haven't bridged that, you may get that result, as she said, that's not really reflective of what fair value is. Nevertheless, if that document is found to carry legal weight in whatever jurisdiction we happen to be working in, the remaining shareholders, equity owners, could end up paying more or less than the fair value of that document or the fair value of that interest if the document carries the day. Now, that's not a role that we take on personally, obviously. I try not to practice law without a license, but the lawyers will evaluate that. And obviously, at some point, the trier of fact is going to make a decision as to whether that agreement carries the day, even if it has one of these short approaches that perhaps Melissa and I don't really think are valid.
So once we get into the buy-sell agreement, what we're going to look for is the definitional aspects of what we do. So we're going to be looking for date of valuation, most importantly, standard of value, how we're going to approach the valuation, premise of value, and the use of valuation discounts, which is a nuance in this area of practice that we get involved with that is very different from the fair market value, and I'll get into that in a second. Date of valuation is very important because any conclusion of value is only effective as of that date. What is known or knowable as of that particular date? So it's going to influence the information that we use and incorporate in the preparation of the valuation. And what happens is when we have an agreement in place, typically there's significant or sufficient guidance as far as what the date of valuation is. But there could be a situation where we don't have a reasonable agreement in place, so there can be fighting as far as what that date of valuation should be. If it's something that goes through the court, if there's a filing that's made, it's the date of the complaint. Standard of value is very important. It's one of the most controversial aspects of evaluation. We could have a description in a buy-sell agreement that basically says, well, we're going to have, upon a triggering event, we want the exiting price to be at the fair market value of the shares. And it will go and actually explain something that contradicts the fair market value standard. So this is an area in which there is a lot of controversy and can be a lot of contention, and there's a lot of dialogue that goes on between the majority shareholders, the minority shareholders, their advisors, and including legal counsel. So it's very important to understand what the ramifications are in selecting that standard of value, because the value can have very different meanings depending on the standard that's used. So here are the most popular standards that we know, and you guys have probably seen in the past with our presentations for different purposes. But fair market value is the most popular standard of value that's used. We use it in the context of ESOPs. We use it in context of divorce, tax purpose valuations. So that's where you have that willing hypothetical buyer and seller, arm's length, reasonable knowledge of the relevant facts. Well, then you move into fair value. The first one is for financial reporting, and I'm not going to get into that too much. But the second is the state statutory. This is a standard of value that is based on judicial precedent. And I'm going to talk about that in a second. We also have that investment value, which we know is based on a premium that is paid by a specific buyer that's over and above the fair market value that we talk about. Intrinsic or fundamental value is something that's based on what an analyst feels is the value of a particular stock. Doesn't have use in this context. But what I want to focus on real quickly is this idea of fair value. Fair value is different than fair market value. Most states, including Pennsylvania, will use fair value to resolve shareholder disputes. So that's when you absolutely have to have a qualified valuator who understands how fair value is interpreted in the state of Pennsylvania. What we follow is the Revised Model Business Corporation Act, that definition. And basically what it is it states that the value of the shares that we're going to be looking at is to be conducted or to be determined immediately before the effectuation of the corporate act to which the dissenter objects or the oppressed objects, excluding any appreciation or depreciation in anticipation of the corporate action unless the exclusion would be inequitable. So most courts, and here it says some courts, but most courts don't equate fair market value with fair value. In your materials, very quickly, the difference between, I'm just going to go over very fundamentally the difference between this fair market value that we see that's an arm's length transaction and fair value. The most fundamental difference that you see in fair market value, we always talk about that willing buyer, willing seller. Well, if you're in a fair value situation, you have a oppressed shareholder or a shareholder that wants to leave, do you think that they're willing, we have a willing situation? So that's first off the difference between fair value and fair market value. The buyer's not always compelled under fair value, but the seller is usually under compulsion to sell their shares in a freeze-out situation or an oppressed situation. So there clearly is a difference if you look at page 22 and 23 of your handouts, but basically the crux of it is fair market value is more of the objective standard of value. Fair value is something that is rooted in fairness. If you think about it, it's going to be fairness to that perceived oppression or that depressed shareholder. You don't want to unjustly enrich the shareholders, the majority shareholders that are staying around by taking unnecessary discounts, and I'll talk about that in a second. Do you have anything to add, Bob?
No.
Okay, so selecting the proper standard of value is paramount. Sometimes we will be using fair market value if that's what all parties agree to, and we have a situation where we can navigate through there and give them the appropriate fair market value of the specific shares. But if it is a situation that ends up in court or litigation, we're going to be working under fair value, which is extremely different. But we are going to be looking to legal counsel to assist us in making that decision and ultimately providing a valuation that is valid.
Yeah, keep in mind that standard of value is a critical element of a buy-sell agreement or a corporate organization document. It's like a shareholders agreement or an operating agreement of an LLC that's going to dictate how much is going to be paid on a departing shareholder's departure from the business. Sometimes there are varying circumstances, but that gets above and beyond what we're talking about. A lot of people like to think that, hey, Joe, I talked to him at the country club, he sold his company, it's like ours. He got $1 million for it, and you're telling me that our company, before you do my share, is only worth $300,000 or $500,000. Different standard of value. And we don't have time to get into all those nuances, but appreciate that that's the point of what Melissa's talking about is we have to basically educate the people that are the parties to the agreement, and they have to appreciate and understand that this is how they're going to get paid out at the other end of the operation.
The premise of value we typically use is going concern unless we know for sure that there's a liquidation situation, and we have two options under that. But most often we're working under that going concern premise of value. So not a lot of that's pretty clear cut, not a lot of controversy surrounding that. But one of the slides I'm going to skip to that's more important is talking about the discounts. We know fair market value. If we're valuing a minority interest, a non-controlling interest, what are we going to do? We're going to take a discount for lack of control and a discount for lack of marketability to arrive at what that fair market value of the shares. Very different when you're working in the area of shareholder disputes, especially when you get to court in Pennsylvania. So you have these options depending on what jurisdiction you're working in. In certain jurisdictions, they're going to disallow both discounts. That's typically what you're going to see in Pennsylvania. There are jurisdictions that allow both discounts. If you move over to the state of Ohio, they have this cash value. It's pretty much fair market value, and they will, in most cases, allow you to take both discounts for lack of marketability and lack of control. And then the last two, allowing a discount for lack of control only, which we really don't see very often, and then allowing only a discount for lack of marketability. In a lot of jurisdictions, we will see the definition of fair value that will allow the consideration of a discount for lack of marketability. That's very important because what are we doing when we're valuing these shares? We're taking a haircut from the pro rata overall value of that particular interest and discounting it. And what's happening in the courts is that's not seen as something that's being fair, because what are we doing? We're unjustly enriching the majority shareholders, the perceived wrongdoers, if it gets to a situation where we have an oppressed situation. So we don't want to be in a situation where we're unjustly enriching the people over here and incentivizing them to actually do this again in the future. So what we're doing is we're looking for that equitable value at the end of the day. You want to hit forensic?
Yeah, so the natural extension of all of this is what has to be done to make the determinations that have to be made to fairly compensate the departing shareholders or equity owners. And that depends on the circumstances, again, and the facts that are surrounding the case and how acrimonious it is, and then what kind of record keeping is available. But very often, we're called upon to move into like a forensic analysis. And basically the forensic analysis is based on this assumption, if you will, by the attorneys that were engaged in, that the shareholder has been oppressed. And oppression in and of itself is a term that has a very broad interpretation across many different layers of courts and states in the country. But basically the generality of it is that it's there to protect minority owners. Basically you can do something that abuses a minority shareholder but not beyond the scope of the protections afforded by state law. And that will always carry the day in our determinations because that's their job. And so they're looking at that kind of protections. You can also see action sometimes brought in 50-50 entities, or one-third, one-third, one-third. But for the most part, that's where we're at. Now, the role that we have to play in these types of engagements, again, it depends on facts and circumstances and what actions are at play. But most often it's the ones that are basically looking at potential fraud and simple financial investigatory procedures to look at what the history has been to kind of prove the malfeasance or the alleged malfeasance by the controlling owners. That's really what we're trying to do. It gets more difficult and more expensive and more time sensitive when you have the offending parties or the alleged offending parties looking like they're covering their tracks. Because if they have all the control features in there, we're all familiar with the idea that collusion makes it very difficult to find where the malfeasance is. Nevertheless, that's what we get into. And we look at financial statement improprieties at times, any number of these items, expense report issues, improper accounting. Those are parts of what we look for. We look for people manipulating the actual financial performance of the company. We saw someone not long ago in a compensatory situation where she was able to get a significant bonus paid on performance of the company. And basically what was going on is she was kind of being a little overbearing with respect to the financial folks in the company and smoothing the financial effects, which basically moved EBITDA to a multiple that allowed her to get a bigger bonus. And it really wasn't proper accounting. So that's the kinds of things we'll look into. Sometimes asset misappropriation. We try to look at the common areas of categories of improprieties, but we're looking for misuse, theft, and misdirection of the assets, as we said before. A lot of times that kind of thing starts small. And so I charge in 2 extra dinners that I took my wife and my sister to. Nobody caught it. Next week, I'm taking my buddies before the football game, and I'll run that through. And eventually, you're running every expense that possibly try to get that tuition bill through the expense report. So the reality is we see that very often snowballing into bigger numbers as well.
Now, that's some creative accounting, Bob.
Yeah.
I think before we move on, the point I would bring out in this section, the forensic aspect of what we sometimes are involved or asked to do is very different. If a lot of clients think that they have an audit, so their auditors are going to catch that. But I think the last study that was released, 3 to 4% of instances of fraud have been caught by the auditors. Very different from when we go in and do a forensic accounting job, because forensic accountants, we're going to be looking at every transaction. And that's why we can see a situation like that gets very cost prohibitive in a lot of situations. But there is a very distinct difference between an audit and a forensic audit. So that distinction needs to be understood, because fraud could still be happening in a company that has audited financial statements.
Yeah, forensic accounting, forensic undertakings are very time intensive, and so it becomes very important to define exactly what the scope of those opportunities are and how we're doing that.
And that's why I said at the outset, it's very important to have a evaluator who's qualified. Bob and I carry credentials that allow us to do that forensic piece. But what's really helpful to our clients is that we actually might be able to uncover that at the outset and kind of set up that expectation that we might need to dig down in some details in more of a forensic matter. So, I mean, I think that's what we want to take from this, is that, in addition to the valuation, we might need to be doing a forensic piece before we even get into determining a value.
We often run into very sophisticated frauds and forensic type applications that are necessary. And a lot of times we will jointly undertake a project like that with members of our Audit and Assurance Services group, because they do a lot of auditing as a start. They're very qualified people to help go in and dig into the bigger detail, the greater size projects.
To kind of wrap things up, I have in your materials 2 recent Pennsylvania cases that involve shareholder oppression. 2 very interesting cases. The first one, the Adler case, actually went down in Allegheny County. And basically, we have a situation, and this was actually a medical practice, where Adler, the plaintiff, he alleged that there was illegal, oppressive, and fraudulent, and that's basically what you'll see in any complaint like this, conduct causing assets of the company to be misapplied and wasted. Also alleged that the defendants wrongly, and there were 2 defendants in this case, they were both 25% shareholders. Adler owned 50%. So still considered a minority shareholder, because he actually does not own 51% in the state of Pennsylvania. But he contended that they wrongly attempted to issue stock and change corporate rules of governance to his detriment. So basically what's happening here, this is a classic freeze out that we see. So the trial court found that ultimately that Adler was oppressed. He was being controlled by the other 2 shareholders who only owned 50%. The oppressive conduct did come in the form of freezing out the shareholder by trying to issue more shares and change actually the overarching governing documents of the company. And what was interesting in this case is that the court actually appointed a custodial receiver, and that's not uncommon in this situation. But what's uncommon is that they actually appointed Adler himself, the plaintiff, and that's not something that we usually see. So this went up to appeals, and the PA appellate court upheld the order of the trial court that appointed him as custodian, and he was managing the business affairs of the corporation. So what the Superior Court of Pennsylvania used in this particular case is that they were looking to the reasonable expectation of the shareholder when they were looking to oppression. So this was a situation where the court came in. They couldn't amicably resolve their issues within the shareholder group. Court came in, and to the surprise and dismay of the defendants, the custodial in this case was Adler himself. The last case is Stager. This actually was decided in 2014, and both parties to the litigation, they formed 2 Pennsylvania LLCs. So they are both 50-50 owners, which is very important. But the operating agreements of both LLCs were identical, and they noted that decisions of the majority are controlling. So one shareholder could not initiate or effectuate any type of control. You needed both shareholder, or both members, I'm sorry, in this case, to effectuate any type of control. Interestingly, both parties, they weren't getting along. Both parties agreed to dissolve their partnership back in 2006, but they weren't able to negotiate a buyout. So they were operating under various issues in which the plaintiff, Steger, was actually not involved in the ongoing operations of the business. So what we have found is the defendant was unilaterally operating both LLCs and did not provide Steger, the plaintiff, with information regarding operations or any money from the business. He was basically frozen out of the business. The court here ordered a dissolution. This is a judicial dissolution, which is in the purview of the court to do this. And that's why I said from the very beginning, you might want to resolve these things prior to getting to court, because they have wide latitude in what their opinions are. So here, what they saw here was a deadlock, and that's the instance in the state of Pennsylvania where the court can come in and order a dissolution. Basically, we had 50-50 shareholders. They couldn't effectuate any type of control without the other, so they're not going to agree. Deadlock, and also they were going against the operating agreements, obviously, because majority ruled. So two very interesting court cases, very recent, that shows that when these things get ugly and get to court, the outcome can be very surprising.
Yeah, that's in particular is a very harsh outcome where they force a dissolution of the company. You would hope that reasonable minds could prevail to keep an operating company alive beyond the idea that the two owners can't get along together. But that was the outcome of that particular case. You see most of these cases better addressed through Delaware Chancery Court. That's where the detail is. Even Pennsylvania leans on that court as a resource for understanding these complex business issues. So that kind of concludes this session. Melissa and I will be around. If you have questions, we'll be more than happy to try to answer them as best we can. And if we don't have the answer, we'll dig up the answer for you. Thank you all.